Hey everybody, Jason Rivera here, just providing some context for the video above, or wherever the video is on this screen once my team uploads it. I'm not sure, I've been having some major sound issues with everything I'm doing lately, webinar, videos, training sessions with a client, so not sure what's going on there. Hopefully it sounds like we fixed it now. Which is why I'm providing context, because a lot of my sound and my answers on the client training session in this post is either very quiet or completely gone for some reason, even though he could hear me perfectly fine on the video. So I'll just get right into it. In this video, I'm going to only provide context in terms of the missing parts of the conversation in this video. I'm kind of having to improvise all of this. So please bear with me. Like I said, we've got the sound issues figured out now, hopefully, finally. But for now, on these training session videos and posts and this case study, for now it looks like I'll have to do it this way, and you'll have to go back and forth between the videos. Again, I apologize for this, not sure what happened, but we got it fixed for future videos. Okay, so I'll get right into it. We started talking about CAD, and I asked him why that was important. This is Canadian dollars. When you go to any site like Morningstar, generally unless you're on the foreign listed stock exchange, Morningstar site or ticker, foreign listed ticker, it is always listed in US dollars on Morningstar. So we have to remember that when we're doing our analysis, that we have to make the conversion rate change at some point. When do I make that change is a question he asked. I always leave it to the end, because I tried to do it at the beginning before when I first started, and I would have to convert every single number every single time, and it just got too confusing to keep track of over time what was converted and what wasn't, and it just took a huge amount of time. So now I convert everything at the end in the per share price. Again, the reason we do this is because if you're in the US or whatever country you're in, you have to know what the share price is in your currency, so you know what, once we get down here further to the EV and EBIT, thinking as business owners, what we would be willing to pay per share for the entire company if we were thinking to purchase the entire company, which as business owners and long-term value investors we should think of. In this case, the CAD versus US dollar, this wouldn't make too much of a difference because they're pretty close. But for example, I research companies all over the world. If you're researching companies in South America or most of Asia, the currency exchange rate could be could make a massive difference in the overall apparent value of the company and valuations and everything. So that is why it's ultra important to always make sure you know not only which currency you're using at the beginning of the analysis, but to convert it to your own currency. In this case, I live in the United States. I always convert everything to US dollars. The next thing that kind of got cut out there was a brief topic about the market cap. Nothing much there. Just make sure you always know where the decimal place is. For example, this is all numbers are listed in millions. This is why I put this there on my preliminary analysis, and this sheet right here is kind of based off of what I showed my coaching client to do, or at least my process of what I do. So with some tweaks of his own to make things better, like the colors. But you always need to know where this decimal place is. So example, as soon as I see that right there, I always know that this is $3.4 billion. Again, if you don't know which decimal place I research a lot of small caps. A perfect example is this could also be 3.4 million. I research a lot of nano caps and micro caps. There's obviously a massive difference in 3.4 million and 3.4 billion. So you need to know where the decimal place is at all times when you're doing your analysis, and that's why I automatically put it at the top. right away. If this was a nano cap, this would be in thousands. If this was a mega cap, this would be in billions. Okay, the next is his explanation of price to book was backwards on his explanation on the video. I corrected that there. It's just the price, the share price divided, or yeah, the share price divided by the book value of the company, and that's pretty much self-explanatory there. He just had his definition backwards, and I corrected him a little bit on that. No big deal. In terms of, and I said this is based off of my worksheet, he has a question in there on, or I had a question for him in there on what the different colors meant, the different kind of formatting meant, whatever. And I tell this to everybody I work with, whatever works best for you and makes most sense to you, I want you to be doing, and you need to be doing, just because it makes it easier on yourself when you're doing analysis. Don't just outright copy anybody else. You need to put your own twist on it, because you need to be comfortable with everything you're doing, everything you're learning, and anything you can do to make your own process easier. When you're doing a preliminary analysis or full analysis, you need to be doing. So the color differences here, some of the formatting things, some of the other topics I don't use, but I was telling him in the video that it's great that he is using his own processes and building his own processes. Okay. The next kind of missing point there is I was explaining to him the importance of having a preliminary analysis process. And this is important discussion. When I first started, I didn't really have a preliminary analysis process like I talked about in the previous post. It would take me literally 1 to 2 hours to evaluate one company on a preliminary basis, and even then I didn't really have a process. I would just kind of do whatever I felt like doing that day. It wasn't regimented. There was nothing specific I would look at on a specific day. It just was kind of how I felt that day and what I wanted to look at that day. But now, ever since I've developed this process, I can research on a preliminary basis 5 to 10 companies in an hour, depending on the complexity of the companies and how long I've taken a break from kind of looking at companies. It's 5 to 10 in an hour. Not only does that help you look at more companies faster, it also this process I've developed also helps you eliminate crap companies faster, so you don't have to do further analysis on them. Also helps you learn business models and industries faster because you're looking at more companies. And as long-term value investors, pretty much the people who win in this game, not only do you have to have patience and you have to know what you're doing, but it's generally the people who are, I think as Seth Klarman put it, who's able to turn over the most rocks, or in other words, look at the most companies in the fastest amount of time. So that is why it's ultra important to have a preliminary analysis process. Even if you don't follow mine, build your own. It'll not only save you a ton of time over the long term, it'll help you learn faster as well. And find better investments is probably the most important part there. Another kind of part that cut out was he was talking about fat pitches. This goes back to the Buffett saying where he wants to wait for obvious stocks and companies to invest in. We were just kind of talking about mindset there and how this process, going through this process every time you evaluate a company, will help you develop that process and help you develop the discipline to only look for fat pitches, which are easy to understand, easy choices when it comes to valuation, margin of safety, stuff like that. I would just kind of explain that to him because, again, that's an ultra important value investing concept and mindset to have. If you don't have discipline, if you don't have processes, if you don't have a long-term mindset and extreme patience, you're going to fail no matter what you know as a value investor. Next thing we kind of touched on was operating margin in the video. Operating margin, he asked, if I remember right, he asked why I use operating margin instead of EBITDA or or otherwise known as net income. Before I go back, let's step back. I've explained this before this video to him, but he just was kind of a little as he said, chunky on it, as well as understanding, is operating margin. To me, I use it because it is, and it's also known as EBIT or operating profit as well. It's not just operating margin. Operating margin to me, and why I use it, is because it is truly the profitability from the company's operations after accounting for things like cost of goods sold, which is a basic cost that pretty much every business has, is cost of goods sold. So this essentially to me is the profit a company produces from its operations. I want to know why I use this is because instead of EBITDA is net income, can be EBITDA, also known as net income. Let me go back on that, because I'm sure some of you probably don't know what that means, or that they are exactly the same thing. EBITDA is also called by many long-term deep value investors bullshit earnings, because if you have net income, that's after taxes. You can literally, if you have good enough lawyers and good enough accountants, you can make the tax rate whatever you want, or even zero for a gigantic company like GE several years ago. There's a huge outcry that they figured out a way, due to all their legalities of the tax code system, tax credits, whatever it was. I don't remember the exactly what it was, but they, multi-billion-dollar corporation, worldwide corporation, ended up paying zero taxes. I want as clean of numbers as possible, which is why I focus on operating margin along with free cash flow, which you'll see down here, on a preliminary basis. I want as clean of numbers as possible. It's also harder to manipulate things like free cash flow and operating margin than it is to manipulate net income, in terms of things like smoothing earnings over quarters and stuff like that. Those are some more reasons why I focus on operating margin instead of net income or EBITDA. The next part he talks about is his goal is to, and these kind of next two parts that go together with each other, he stated his goal was to learn enough with this program to produce 20% year returns, which is fantastic. As he alluded to in the video, 20% is pretty much what Buffett has done over his entire 52-year career, or whatever it is now. So if you can do 20% a year, you're going to become extremely wealthy over time. And then I was talking to him not only about that and how that's a fantastic goal, and that's what I want to help him be able to produce on his own over time, but also the importance of goal setting, writing down your daily goals, and working towards building a plan and working towards those goals every day. I'm a huge believer in that. We were talking specifically, I believe, about the Grant Cardone 10X planner and how that's helped both of us kind of change our mindsets and change how we look at goal setting and working towards our future goals. Okay, thanks. That, I think, covers everything, all of the kind of missed spots in this video. I'll make another video for the other ones when I release the other videos. And again, I apologize for this. Not sure what happened, and hopefully we fixed the issues now. Thanks. Talk to you soon. Hope you are enjoying the case study. If you have any comments, questions about this video or what we've gone through at this point in this case study, please let me know in the comments below. Thanks.